Hello and welcome. I'm Jennifer Hermes Nastu, Content Director for Environment+Energy Leader. And I want to thank everybody for joining us today for today's E&E Leaders Live webinar. Today, our webinar is sponsored by Velocity EHS, and I'm excited to introduce our speaker, ESG subject matter expert David Staples, who is David's Senior Solutions Strategist for Velocity EHS. Right. Well,
That's right.
Welcome. Great. Thank you so much for joining us.
Thank you, Jennifer, for having me. Appreciate it.
Yeah, we're excited to hear what you've got to say on the topic. So we'll get started in just a minute, but first I wanted to thank everyone who's joining us live and to extend a large thanks in advance to folks who are going to be watching this later on demand, and we really appreciate everyone joining us. So today we're talking about ISSB's consolidation of ESG reporting frameworks, what you need to know. So David's going to talk to us about the background of the formation of the ISSB and the contents of its first two draft standards, and provide, David, I'm really looking forward to the key takeaways about the future of ESG reporting. So, but before we jump in, could you tell us a little bit about yourself and your work with Velocity EHS?
Sure. So I'm part of the product team at Velocity EHS on our ESG platform. So as you mentioned, I'm a solution strategist, and what that really means is that I'm kind of a filter for marketing, for our product managers, for our sales teams, to really make sure that our products are meeting what the market is demanding, that our marketing messages are on point, that our salespeople know the value add creation, the statements, the key points that they need to hit on, and the value that we're adding to organizations. So that's a little bit about my role. I studied, did a master's degree in corporate sustainability way back in 2010. So I've been in this space, excuse me, for a long time. And since I graduated, I have been with Velocity EHS. So it's been going on 12 years now with the company.
Great. So it sounds like you have wonderful expertise to talk about this topic. So let's jump in. One of my first question is, how exactly would companies that are following the ISSB standards, how do they disclose their ESG information? Would it be in a new kind of report or in their regular financial statements? And you know what, maybe before you answer that question, do you want to give a real brief explanation of what the ISSB standards are, or
Sure.
How they came about?
Yep. No, definitely some background is in order before we get to how disclosure works, Jennifer. So thanks for the question. Thanks for having me. And I'm really excited to talk about the subject for reasons that hopefully will become abundantly clear as we move on with the discussion. But the ISSB was well, let's start actually with the International Financial Reporting Standards, or the IFRS Foundation. They've been around for a long time. They're promoting traditional standard financial accounting standards such as GAAP, or generally accepted accounting principles. And they do this via the International Accounting Standards Board, or the IASB. So the IFRS's financial standards are they're accepted in 140 countries. So, they're uniquely qualified to move in and start helping to standardize sustainability accounting standards, much like they've done with financial accounting standards. So last year in 2021, the IFRS Foundation created the International Sustainability Standards Board, the ISSB. And so under the IFRS, we have the IASB, which is the traditional financial accounting, and now as their counterpart, the ISSB, which is on the sustainability accounting side. And they were created at COP26 in Glasgow, and they came about to address the growing demand for more consolidated reporting frameworks from the G20 group of nations, and also the International Organization of Securities Commissions. So the ISSB has been hard at work and proposed two draft standards. These standards, thankfully, build upon the foundations of the Task Force on Climate-Related Financial Disclosures, or more commonly known as the TCFD, and B, the industry-specific requirements based on the SASB standards. So, of interest, just this month, the Value Reporting Foundation, so that's the group of folks that are responsible for the SASB standards, they just merged with the IFRS to help establish the ISSB. So that's a little bit about, the ISSB and how they fit in the umbrella under the IFRS.
Perfect.
Okay. So the ISSB, they came up with two standards, as I mentioned before. So the first standard builds upon the SASB standards, and they're calling it the General Requirements for Disclosure of Sustainability-Related Financial Information. So it's a mouthful, but essentially it's disclosure on traditional sustainability, ESG related information. But specifically, they're looking for organizations to disclose information on significant sustainability-related risks and opportunities that is useful to assess enterprise value by the investment community. Materiality, so what's important here is determined based on if the sustainability-related financial information is necessary to make informed investment decisions. And the disclosures are around 4 pillars, and they are governance, strategy, risk management, metrics, and targets. So those are the areas that they're looking for organizations to disclose on sustainability-related financial information. The second disclosure is on climate-related disclosures. You could argue that that is sustainability-related as well, but these are more specific around climate change, greenhouse gas emissions, and those things. Mm-hmm. So under the climate-related disclosures, which builds, as I mentioned, on the TCFD, the ISSB is looking for organizations to disclose information about exposure to significant climate-related risks and opportunities, information on the management and governance processes used to manage climate-related issues, information on how the business model, strategy, cash flows can be impacted by physical and transition climate risks such as floods, droughts, reputational damages. They're looking for plans or targets on climate risks with information on how these plans will be resourced and how progress will be monitored. Ideally, they're asking corporations to use climate-related scenario analysis that aligns with the Paris Agreement to assess risks and opportunities. So that essentially means keeping warming to below 2 degrees Celsius and being net zero by 2050. And finally, in accordance with the GHG protocol, disclose your absolute or your total scope 1, 2, and 3 emissions, including intensity-based calculations per economic or physical output. So what your GHG emissions are per $1 million of revenue or per widget that an organization may produce. So they're looking for both those different types of disclosures on greenhouse gas emissions. Now, as to the specific question on disclosure, Jennifer, that you asked, it's actually pretty simple. The ESG metrics would appear in a company's regular financial statement. So there's nothing new or another document that you need to create to hold this information. I would argue that this is a subtle but informative move by the ISSB, as it demonstrates that they place the importance of ESG metrics on par with traditional financial metrics for investors to make informed decisions. Okay, good.
You managed to make a lot of acronym soup very understandable. So thank you. Okay, so can you briefly talk about the SEC proposed rule in the US and how similar the disclosures proposed there are to the types of disclosures proposed in the ISSB's draft standards?
Yes, that's a good question, and it's very pertinent, particularly obviously for the American companies on the scene. And there's a lot of proposals going on, so we want to know, are they similar or are they totally divergent from one another? And the good news is, similar to how the ISSB built upon SASB and TCFD, the SEC and the ISSB's proposed rules share a lot of similarities. So just to rehash or go back to what's going on with the SEC is they proposed a rule for companies wishing to list on the New York Stock Exchange that they must disclose climate-related information, and that climate-related information is very similar, as I mentioned, to the ISSB. The similarities between the two proposed rules, there's 5 that I would like to cover.
Okay.
The first is disclosing scope 1, 2, and 3 GHG emissions according to the GHG protocol, both in absolute and intensity terms that I mentioned earlier. Both proposals are looking for that. Just as an aside for people out there, every major standard, reporting standard out there follows the greenhouse gas protocol developed by the WRI and others. So it's a really good idea to get familiar with the protocol and how to track, specific ways to track greenhouse gas emissions. The second similarity is disclosing governance on climate-related risks. Thirdly, disclosing transition plans. Fourthly, disclosing reduction targets. And lastly, the use of scenario analysis. So putting in place potential scenarios of future production, different pricing on carbon scenarios, and what that would be to what type of risks would that place on the business model. The other thing that I'd like to mention, aside from what you have to disclose and the similarities, is actually the method of disclosure is also very similar between the two proposals. The SEC rule would require companies to report ESG metrics such as greenhouse gas emissions in a company's regular financial filings, such as the Form 10K, and as a note to consolidated financial statements. So again, don't have to create a new report, a new document. It's really just adding to the existing financial reports that organizations already have to create.
Okay, great. Thanks. So one of the things you mentioned earlier was materiality. So I'm wondering what role assessment of materiality plays here in terms of better ESG management.
Yes, right. Well, as the old adage goes, to manage something, you first must measure it. Materiality is pretty simple. It's just about picking the right things to manage. Understanding what type of information your company's stakeholders are looking for to determine how well you're managing ESG, while also painting a picture of your enterprise value for the investment community, will be key to keeping access to capital open, or at least your cost of capital lower. Without a materiality assessment, you're really just rudderless and guessing what's important. For example, Tesla, the electric vehicle company, they just got booted last month out of the S&P 500 ESG index. Folks on the call here might be wondering, how a company pioneering electric vehicles could not have a good ESG performance. Well, they don't have a good track record on codes of business conduct. They have reports of poor working conditions, and they even had to pay a settlement to the EPA for violations of the Clean Air Act. So they score very, very well when it comes to scope 3 emissions of their product. The life cycle of the product, there's not a lot of emissions coming from their vehicles. But perhaps if they completed a more thorough materiality assessment, they would have uncovered holes with their overall ESG program, and would have, through the materiality process, had better ESG management. But they were relying on the laurels of their product and forgetting about how they go about building their product and the way they conduct business.
Right. That's really interesting. I actually was curious about how that happened. So that's some good background information. And so I have a follow-on question to this one. Do you have thoughts on how, I know this is a big topic, but in terms of conducting a materiality assessment, what's the best way to go about that, or where would you start?
Yeah, so the best way to conduct a materiality assessment is to approach with a perspective that you don't know what you don't know. A lot of environmental managers and executives will sit around a boardroom amongst themselves and think about what is important to the organization. But that might not be, that's one stakeholder. Employees, executives is one stakeholder of a multitude. There's suppliers, there's investors, there's the local community. There's a whole group of stakeholders which may or may not be reflected in the ideas around the boardroom or in the office. And so starting with a survey of stakeholders and just coming with a fresh perspective, and let's just park our biases or our initial thoughts of what we think we need to focus on, park those to the side, and let's engage with all our various multitude of stakeholders and ask them what is important to them, and then bring that in-house and chew on that for a little bit. So I really think don't come up with any ideas of what you think is important and what you think you need to focus on. Obviously, there's frameworks like SASB and looking at the industry reporting guidelines that they have that you can rely on as well. But if you have the time, I would always suggest with starting with a stakeholder survey or stakeholder review process.
Interesting. Okay, thanks. So getting back to ISSB standards, and this is what I'm really interested in hearing, and I know our viewers will be too. So the big question, what advice would you give to businesses as they're preparing to follow the ISSB standards once they're finalized? How, what do they need to know?
Sure. So these exposure drafts by the ISSB, they're open for public comment until the end of the month, specifically July 29th, with a desired completion date by the end of this year. So my best advice is to start getting your house in order now. Companies choosing to follow the ISSB's directives won't be reporting until 2024, covering calendar 2023. But there's some tasks like performing a greenhouse gas footprint that takes time to do. So you want to have the processes for data collection, the initial data sets already available when it comes time to report. Setting this up will also help companies prepare for the SEC rule. The greenhouse gas footprint analysis that you prepare for your company is just as applicable to the ISSB as it is to the SEC. You don't have to do a different footprint or calculate your greenhouse gas emissions in a different way. So you'll be able to cover a multitude of reporting frameworks by your greenhouse gas footprint. I also wanted to mention, Jennifer, that what is being proposed here by the ISSB is not mandatory. But the ISSB is working closely with other international organizations, as I mentioned earlier, the international organizations for all the world's stock exchanges, to incorporate these standards into jurisdictional requirements. So that's code for might be mandatory soon.
Right.
And reporting will also placate your stakeholders, your investors, your supply chain partners, and others. So the main advice is that it is voluntary, but most likely bits and pieces will be mandatory. The SEC rule will obviously be mandatory if you're a public organization, and get started as early as possible because some of these things take time.
Right. That's interesting. So be ready, get going so that if it does become mandatory, and you're saying at least pieces of it absolutely will, that you're ready when that happens.
Yep, that's right.
Okay, so we have a few more minutes. I have one last thing I know our viewers will be curious about. I'm wondering, can you talk to us a little bit about technology and software? How is that going to help companies with improving their tracking, their disclosure of ESG metrics?
Right. Yep. So technology can definitely help in several key ways. There's a lot of software platforms out there that have reporting aligned to common frameworks, so SASB, GRI, CDP, out of the box. So this will help organizations identify which metrics to report on and fulfill multiple frameworks at the same time. So if you don't have the time or the desire to do a stakeholder assessment, you can just rely on a software application that is already, you just type in electronics manufacturer. So SASB says that here's 37 metrics that you have to report on because of your industry. So there you go, you're off to the races. At least you know what data you have to track already. Most software out there also embeds the GHG protocol, which I mentioned is ubiquitous amongst the reporting frameworks. And within the GHG protocol, excuse me, I'm just dealing with a bit of a hangover of a cold.
Okay.
Yeah. There's a myriad of emission factors required to generate your GHG footprint. Scope 2 emissions from electricity consumption alone can require hundreds or even thousands of factors depending on how many locations an organization has and where they're located. So software already has all your emission factors, electricity in West Virginia, California, Pakistan. You don't need to worry about, the sources of generation. It's coal, it's natural gas, it's a whole bunch of things. It changes every year. How much nitrous oxide, methane, CO2, global warming potentials, its equivalent in CO2e. You don't need to worry about any of that. You just need to put in, I consumed, 1 megawatt hour of electricity in Karachi last month, and the system does, will do the rest. It's up for public consultation whether GHG emissions will be reported as CO2e only, or if constituent GHGs will also be required, so the methane, the nitrous oxide. But either way, software will help an organization determine either your constituent GHG emissions or their equivalent CO2e. Software. Some software platforms can also automate the tracking of utility data. So you don't even have to enter how much electricity, how much natural gas you entered. So the reporting is not upon your facility folks. Some software platforms have a direct link to these utilities, and so we just grab the information on the back end, integrate with the utilities. So there's no reporting onus on clients. Obviously, software can monitor progress in real time. That's another key benefit. And lastly, a lot of software platforms can report on both location and market-based emissions by keeping track of renewable energy credits or other market instruments that companies are purchasing, so they can reduce their market-based emissions.
Mm-hmm. So there's a lot, obviously a lot of software providers out there. Do you recommend that companies use a consultant to help them make that decision, evaluate, what they're looking for? Or is it pretty easy to figure out who or what you need?
Well, it depends. So I feel that consultants are valuable if you don't have any type of ESG program, you don't know your sources of emissions, you don't have processes and procedures, a plan, a management plan to report, track, monitor, manage, if you will, your ESG processes. What type of social metrics are important, what type of things that you want to do as an organization as a goal, because software is only going to be a medium to achieve your goals. It's not going to tell you what your program should be. So consultants can play a great role, particularly for larger, medium and larger organizations, to set up your programs and then use software to automate and streamline the programs that you have. Some companies definitely hire consultants to select vendors. But if you've already got a program in place and you know what you want to achieve as an organization in terms of your ESG profile, there's no reason why you can't evaluate vendors on your own. Verdantix is a great resource. Their ESG quadrant that they recently came up with, or their EHS, traditional EHS green quadrant, they've got a pretty good mapping of the software platforms that are out there today. And so, looking at that as a reference guide and perhaps picking, 3 to 4 or 5 vendors to go through demonstrations and conversations with will be good. So depending on where you are, the maturity you are with your ESG programs, it may or may not make sense to hire consultants to help you with that.
Got it. Okay, good to know. So David, we're almost out of time. Is there anything though that we didn't get to touch on that you want to mention before we say goodbye?
There's just 2 key takeaways, I think, Jennifer, that I'd like to leave the audience with today. The first is that the proposed standards from the ISSB reflect the growing importance of ESG reporting to stakeholders, particularly the investment community. The investment community is saying, I cannot make informed investment decisions without ESG reporting. I am no longer able to make fully informed decisions based on traditional financial metrics alone. Your income statements, your growth prospects, your balance sheet, that alone no longer is sufficient to determine the risks an organization has in our new world of moving towards a low carbon future. The second key takeaway is that the ISSB's work was recently endorsed by the G7 finance ministers and central bank governors, so that holds a lot of weight. So this is further indication that the sustainability reporting framework ecosystem is starting to consolidate and coalesce around the ISSB. There's been a lot of frameworks. There's even new frameworks coming up, but the ISSB is really, in simplistic terms, a merger of TCFD and SASB. So, and they were already very integral to the reporting ecosystem, as it were. Now that they're merging under the ISSB and the backing of some serious global organizations, I feel that this will become the gold standard of ESG reporting moving forward.
Great. Okay. Well, that's good information and good advice. And that's all the time we've got today. But David, thank you so much. I really appreciate it. You shared a lot of great information with our viewers. I know they'll find it valuable.
Great. Well, thank you for your time, and have a great rest of your day.
Thank you. You too. And take care of that cold. And to our viewers, thanks so much for tuning in. We appreciate you joining us today for today's episode of Leaders Live, and we'll see you next time. Thanks. Bye-bye, David.
Bye-bye.